Hi folks, and welcome back to Meaningful Money. Okay, I'm still here in my garage, study, workroom, utility type room because both time and the weather are against me a little bit. This week my two daughters are in a show with the local sort of youth theatre group, so it's practices every night, lots of ferrying them to and from rehearsals and stuff, and so it's all a bit manic. So sorry about the fairly uninteresting background, but it's the content that matters, so thanks for being here once again. Episode 194, I believe, talking about the tax year end. Excuse me, little nose itch, as often plagues me on these videos. We're approaching the tax year end once again on the 5th of April. It's the last day of the tax year. So there's a couple of things you need to think about in advance of that. So as ever, before we get into the meat of that, my good friends down here, about there, Seven Investment Management, who continue to sponsor me, and I'm very grateful to them for doing so. Now, tax year end, 5th of April, there's always some things you need to think about. This is a busy time of the year for advisors as we're ringing around and running around seeing clients, making sure they use up their ISA allowances and things like that. And that's the first thing you need to think about is your ISA allowances. One of the best ways, if not the best way to save long term are ISAs. Remember, you can have cash ISAs and stocks and shares ISAs. Now, this year's allowance is £10,680. Benefits of ISAs is that, well, cash ISAs are simply tax-free bank accounts, so any interest you get on a cash ISA is paid to you tax-free. A stocks and shares ISA is free of capital gains tax and largely free of income tax. Not completely, where a stocks and shares ISA invests in shares and dividends are paid. Remember, there is a little bit of tax taken off when you get those dividends notionally, and you can't get that back. So not completely income tax free, but to be honest, as near as damn it. And so you get £10,680. Next year's allowance, so you'll be able to use this again after April the 6th, is going to be £11,280. It'll probably take me until about August to remember that. And also remember junior ISAs, new innovation this year. There's a £3,600 limit per child on junior ISAs. Remember though that children who have a child's trust fund, which is the predecessor to the junior ISAs, can't yet have a junior ISA, unfortunately. It's either or. But these are ISA allowances, they're tax-free saving allowances. There's not many tax breaks around at the moment, not many good reasons to invest, one could argue, so a tax allowance like that should definitely be used. Particularly as far as the junior ISAs are concerned, I'll stick a link up here in the corner to episode 155 where I explain all about junior ISAs. So click that and it'll take you there. Now, the other thing you should do at the end of the tax year is to think about your capital gains tax allowance. Now, capital gains tax is the tax you pay when you make a gain on an investment of some kind. And everybody gets an allowance every year, currently of £10,600 that they can gain in any one year without being taxed. But if you're likely to make a gain bigger than that, then that requires some planning to pay as little tax as possible on it. Now, the capital gains tax allowance is lost if you don't use it. You can't if you don't use all your allowance this year, you can't carry it forward to next year and carry it forward again until you end up with a really big allowance and make your gains in that year. Now, if you don't use it in any one year, it's lost, and so you should make pains if you can to use your allowance. Of course, you've got to have a gain that you can realise to use it. But it's really valuable. I mean, a higher rate taxpayer who would pay capital gains tax at 28%, by using their allowance would save just under £3,000 in tax, £2,968. Even a basic rate taxpayer, by making a gain and using their allowance, can save £1,908 in tax. It's a really valuable allowance, so worth looking at if you've got some gains. Now remember that you can't do something which you used to be able to do called bed and breakfasting, which is where you sell some shares today and buy them back again tomorrow. So you sell them today, realise the gain, and then buy them back again tomorrow. You can't do that. There's now got to be a 30-day window before you can buy them back again, and that's a long time to be out of the stock market, particularly at the moment. But what you can do is bed an ISA. So that means you sell the shares today, buy them back again tomorrow, but within an ISA, because it's a different wrapper, that's allowed. Or you can bed and SIP. Ready? Now we're getting technical. So you can sell your shares and buy them back in your pension tomorrow if you've got that kind of pension arrangement. Or you can bed and spouse, which sounds like something for an entirely different kind of video, but where essentially you sell the shares and your spouse buys them. So you still own them together, but you've bought each other's shares. So there's some options there. If you have a large gain, which is one too big to fall within the allowance, consider realising that gain, if possible, over 2 tax years. So if you've got a share portfolio with some gains on, which are sort of £20,000, say, worth of gains, where you could sell half the shares this year, and we're very near the tax year end, so you could sell half the shares in a month's time and use next year's capital gains tax allowance for that. So use that allowance. It's another very valuable one, and at the tax year end is a good time to think about some planning. And then finally, if you're in a position where you've got a bit of an income tax problem and you've got some money kicking around you can invest, you could consider venture capital trusts or enterprise investment schemes, which are also useful. They have annual allowances, and there's going to be few people watching these that will benefit, I imagine, from those. But they are explained in detail. Again, links up here back in episodes 116 and 117. That's VCTs and EISs. So that might be interesting to you. Okay, so end of tax year. I haven't spoken a word about pensions, so that's what I'm going to talk about next time. Tax year end planning with pensions. So thanks for watching this one, and I'll see you next time.